Good afternoon, everybody, and welcome to this, which is the final session of today, where we're going to be talking about the impact of trade wars on financial markets. So, first of all, I just want to let everyone know, welcome to the delegates in the room, but also welcome to those of you who are joining us on the live web stream. You're all very welcome to tweet about this and indeed any of the sessions, and the hashtag is hashtag PLSA Invest 19. So I'm Carol Young, I'm Director of Reward Pension and Benefits for RBS and a Policy Board member with the PLSA, and I am delighted to be joined today by Nathan Sheets. Nathan is Chief Economist and Head of Global Macroeconomic Research at PGIM Fixed Income and a former Undersecretary for International Affairs for the US Department of the Treasury. And Nathan is going to talk to us, as I said, about the impact of trade wars on financial markets. I know some of you were thirsting for some upbeat responses in the last session. I don't know if we're going to meet that goal, but we certainly will aim to leave you more educated and informed than when you came in. Just to let you know before Nathan begins that there is going to be a polling session in here, so please do have your apps to hand. There's a couple of questions where we'd really love to get your view. And please do, Nathan's going to talk for sort of 25 to 30 minutes, but please do keep the questions coming in at that point, and then I'll be sure to put them to him in the time that we've got left available. So over to you, Nathan.
Thank you. Well, it's very much a pleasure to be with you today. My thesis that I'll develop over the next few minutes is that the global trading system is under pressure. And when I look out in the world, I see a variety of sources of those pressures. First, distinct macroeconomic headwinds. Growth has been somewhat slower, investment has been somewhat slower than before the financial crisis. Secondly, we're seeing a fragmentation of global trading structures, and in particular, WTO relationships. Multilateralism really is on the ropes right now. Many countries have kind of pivoted into regionalism, but as the situation with Brexit highlights, even that is facing some challenges. A third source of stress is the recent eruption of trade wars. And here I would describe this as the United States, so far mainly the United States, being more willing to use tariffs as a tool of national economic policy than has been the case for a number of decades. Really quite an extraordinary change in the posture of US policy. And then finally, and maybe most importantly, it seems to me that we are seeing heightened public ambivalence about the benefits of free trade and capitalism. And I think this is flowing from a sense that the benefits have been too concentrated in certain parts of society and have not been sufficiently shared across the income distribution. So these are the challenges, and I'll talk about them in more detail over the next few minutes. And then also we'll conclude with some thoughts about what all of this means for financial markets. So first of all, I mentioned global trade is experiencing some macroeconomic headwinds. So I think the red line on the left here, which shows the share of GDP, or share of trade relative to GDP, kind of highlights this point, that from the 1960s into the time of the global financial crisis, global trade relative to GDP tended to march steadily up. There's a little period of flatness you see there in the 1980s, but was generally on a rising trend. Since the global financial crisis, trade as a share of GDP has plateaued, and in recent years has actually retreated notably. Now, the blue line shows export volumes. In volume terms, trade has continued to grow through this period, but at a slower rate than was the case before the financial crisis. And that's what the slide on the right highlights, is that from 2002 through 2007, global GDP growth averaged a little over 7%. In the years since the financial crisis, global GDP growth, or let me try that again, trade growth averaged a little bit over 7%. In the years since the financial crisis, trade growth has averaged only 2.5%. Now, why is that? Well, one explanation is the global economy has grown more slowly. Before the financial crisis, the global economy was growing 4.5%. Afterwards, it's only growing 3.5%. A slower growing economy is naturally going to have slower growth of trade. But that doesn't explain all of the slowdown. That before the financial crisis, 1 unit of GDP growth was associated with 1.6 percentage points of trade growth. And after the financial crisis, that same statistic is only 0.7. So the elasticity or the sensitivity of trade to GDP has been cut in half. What's going on there? Well, as I mentioned a moment ago, trade is particularly intensive in investment, and investment has been soft globally since the time of the financial crisis. I would say in addition, in some countries, maybe notably China, there has been some unwinding of supply chains where they've tried to bring production home and they've worked to consolidate trade. This was a big development a few years ago amongst the Asian countries. And then third, I think there are some structural issues that have weighed on trade that I'll talk about now. So a second factor that's proving to be a headwind is this fragmentation of global trade structures. I think the bottom line here is multilateral trade approaches personified and embodied by the WTO are under attack. The Doha round, which was an effort, was kicked off in November of 2001 by countries across the world to further liberalize trade on a multilateral basis, really didn't go anywhere at all. The fundamental issue there was a difference of perspective between the advanced economies and the developing countries about relative roles and responsibilities of these two classes of countries. In some sense, to make matters even worse, President Trump and his administration have been quite critical of the WTO. And instead of referring issues to arbitration at the WTO, has instead utilized unilateral kinds of approaches, like Section 301 investigations, which are authorized under US law, but are not internationally recognized. Given the slow progress of the Doha round, the Obama administration, when I was serving as undersecretary, we were focused more on regional agreements like TPP with the Pacific nations, bilateral agreements like TTIP, which would have been a deal between the United States and the European Union, and then so-called plurilateral agreements, which you can just think of a plurilateral agreement as a coalition of the willing. And an example of that was the Trade and Services Agreement, which sought to liberalize the services sector in a way that we haven't seen for decades. Now, President Trump rejected these initiatives and instead is focusing on negotiating bilateral trade deals. And he started those negotiations with the European Union and Japan. But it's still got a long, long way to go. Now, President Trump, when he was elected, as you know, was very critical of NAFTA. Once he was actually sitting in the Oval Office, he kind of had an epiphany and realized, well, maybe there are some positive economic and maybe even more importantly, some positive political benefits of NAFTA. And instead of just blowing it up as he said he was going to, he renegotiated it. And I would say importantly for him, he renamed it. It went from NAFTA to the USMCA. Even as I say this, and it's an important point, the USMCA is now sitting in Congress where it faces, my expectation is it will be approved, but it faces some significant challenges. Finally, beyond the United States, I'd say the story for trade is at best mixed. China is trying to piece together a regional trading region called RCEP, which would be the Regional Comprehensive Economic Partnership. That progress has been very slow. I'd point to Brexit, as I did a moment ago, as an example of fraying European trading relationships. If there is good news out there, I would say that once Trump pulled out of TPP, the other 11 nations that would have been part of TPP banded together and said, you know, even without the United States, we're moving forward with that. So the TPP 11 seems to be getting a fair amount of traction. Now, let me turn to the trade war, which I see as another indication of the headwinds and another manifestation of the headwinds that global trade is feeling. President Trump is using tariffs to challenge China's policies on trade and investment. Now, while I have lots of reservations and concerns about the unilateral use of tariffs in this way, I also have to add quickly that many of the criticisms of China's trading strategies that the administration is articulating have been shared by previous administrations. And there are things that the US has been negotiating with China on for a long, long time. Things like how open is their economy? Is there a level playing field for US and foreign firms? Intellectual property rights, non-tariff barriers, et cetera, et cetera. Now, I think one simple indication of the extent of these imbalances is the left panel here. So when you look at it, US imports of goods and services from China are roughly $560 billion, okay? Now, our exports to China of goods and services are about $180 billion. So it's about a $370 billion trade deficit. Now, as an economist, I have to quickly say there are a lot of things going on here. And one of those things is clearly China produces a lot of things that Americans like to purchase. And that's part of the story. Another part of the story is China has more savings in the United States and savings investment balances. These deep macroeconomic factors matter for trade. But I really do believe that this imbalance between our two countries represents and indicates the presence of some of these asymmetries that I described. Another take on this is on the right panel, where in particular those gray bars show the share of the US trade deficit that's accounted for by the bilateral deficit with China. And it's roughly now about 60%. So it's quite high. Another way to frame it is, maybe with the exception of auto trade, US trade excluding China is pretty much in balance these days. So let me talk a little bit more about what it is exactly the US is trying to achieve in this confrontation with China. The key point here is that the Trump administration has defined the relationship with China as fundamentally one of strategic competition. Very much defined it in a zero-sum space. If China wins, US loses, okay? The arenas of competition include trade, but also include this whole list that I have on the slide: technology, intellectual property, investment, cybersecurity. All of these are important to the administration. Diplomatic influence and military standing. So I think the way to think about it is the US administration is pursuing a China policy where it intends to compete with the Chinese across a whole different set of issues. And what President Trump is doing is he's kind of ebbing and flowing. Right now, he's pushing hard on trade. When trade is resolved in some way, and I'll talk more about that in a minute, when trade is resolved in some way, then is everything peaches and cream for the US-China relationship? No, I don't think so. I think he'll then engage in another dimension, maybe on cyber or investment or diplomatics or some other place. So I think that the US-China relationship in the years, at least of the Trump administration, and maybe even thereafter, is likely to always have some tension associated with it. But by the same token, I don't think it's going to be so much tension that it's going to result in a disruption in the relationship. I think both the United States and China realize we've got to work with each other, given that they're the most populous country and the United States is the country with the biggest GDP. So I think that's what the administration is seeking to do. Now, let me also say President Trump is constrained by two important considerations: markets/economics, and second, politics. On the market side, the way I put it is the one thing that President Trump likes better than needling China about trade is a rising equity market. Okay? And we saw that in December. The concerns about the trade war were one factor that were contributing to market stress. Trump goes and meets with Xi Jinping in Buenos Aires, and as a sharp divergence from his previous rhetoric, Trump decides that he's going to start negotiating. And I really think it is Trump recognizing he wants to push this thing with China as far as he can, but he doesn't want to sacrifice the US, the global economy, or the markets in the process. And he had kind of come up to that line where it was starting to do that. The second constraint on Trump is he doesn't want to go into the November 2020 election with these tariffs in the air. That is politically risky for him. There was a political cost to President, it wasn't huge, but there was a political cost to President Trump and the Republicans during our midterm elections in certain parts of the country. So those are the two constraints, and I think that they will be binding in various ways going forward. So now, what are some possible scenarios? I see three: de-escalation, second, protraction, meaning the negotiations just continue, and the third is escalation. Trump decides China's not giving him enough, and he decides to go ahead and raise tariffs on China. Now, over the last even week or 10 days since I finalized these slides, the wind has blown more and more, I believe, toward de-escalation. I am increasingly confident. If I were to write down probabilities, I would probably write down higher probabilities for de-escalation and lower probabilities for the other two than I have on this slide. It is quite clear that President Trump and President Xi are going to be meeting the end of March. It also seems that the negotiations are making progress. President Trump and President Xi, I would very much expect, will agree to something. And now I think the operative question is, what are the two of them going to agree on? Is this going to be a substantive trade deal that addresses not only China buying more soybeans and liquefied natural gas, but also cuts to some of the deeper issues like intellectual property rights and non-tariff barriers, and technology and the technology transfer and so forth. So I think there will be an agreement. The question is, how good will it be? And one frame on this you can watch, which will be quite apparent. Is this a deal that the two sides say, we're done, and they shake hands and they walk off? Or is this a deal that's more like a framework? This is often what heads of state generate, is a framework. And then secretaries and undersecretaries and others, trade negotiators, spend a lot of time filling in the details. And I, for one, am hoping that we don't have them. There would be something nice about finality. But I'm hoping that they don't claim that they've all got it figured out at this stage. These issues are just too complicated. They haven't spent enough time yet across the table from each other to have really, really resolved them. So my instinct is if they say they're done, that kind of means that President Trump is just saying, I want a quick win. And he's walking away without having really resolved or addressed these issues. If the two sides walk away and say, well, we're making enormous progress, our leaders have given us a framework, and we'll figure it out over the next 3 or 4 months, that's the best case. So we'll just watch that. Hopefully it will be a deal that addresses these real underlying asymmetries. But now we get to use the app, and I want to hear your views on this. How do you see it? Are you expecting a quick deal? Agreement reached in March or April, where Trump is looking for a quick win. Something concluded later in the year that might be more substantive. Protraction, do you put a higher probability on these negotiations just dragging on? Or escalation? President Trump has surprised us before, and I'm sure in the remaining 2 years of his presidency, he'll surprise us again. Is that one of those times? So let me see your response. We'll take a quick look. Fascinating. Okay, great. Maybe that was an early lead. Maybe that's when only 2 or 3 constituencies have reported. I think Remain was ahead for a little while on Brexit night. Okay? So the sense of the room is this thing is going to be with us for a while. I hope we land in B. I'm worried that it's going to be A, and that Trump's going to look for a quick win and move on to the next issue, which the next slide, for better or for worse, shows you what I think the next issue is, and that is, will the trade war proliferate to the auto sector? To be clear, this is not my baseline. I put probably a 25% probability on this, but this is a distinct risk. As the US has been negotiating with China, in parallel, it's been doing investigations on the auto sector and is citing national security concerns as a rationale for imposing auto tariffs. This slide just gives you a few facts about the auto sector. As you see, US runs big deficits in all 3 categories, particularly cars, and has in total an over $200 billion auto deficit. On the right, you see some of the bilateral deficits in the auto sector, which are politically contentious. The biggest is with Mexico. And the reality is a lot of US auto production is migrated south of the border. And Mexico provides much cheaper labor than the United States. Japan is next. Moving off to the right, far right, the European Union is at about 45 billion, so they're third, with Germany being about half of that. The UK is about a $7 billion deficit for the United States in the auto sector. If there are tariffs in the auto sector, my instinct is that they will be principally focused on the European Union and perhaps Japan as well. The key point here is that Trump is a chap who came to maturity during the 1970s. And during the 1970s, autos was where the action was. And the US lost a lot of market share to the European Union and to Japan. And President Trump is focused on trying to set that right. Now, there may also be an even, and I'll use this word, an even more clever motivation for going down this road, if he chooses to do so, is I think he's playing out a negotiation where the United States puts auto tariffs on the European Union. Germany is going to want those tariffs off desperately. Trump's going to walk in and say, okay, I'm happy to remove these auto tariffs, but first let's talk about tariffs and protection in your agricultural sector in the European Union. And that's going to kick off quite a divide between the Germans and the French. I think that this has got to be a scenario that he's playing through in his mind, and I honestly have no idea how that would play out, other than it would be quite stressful for European institutions. So now, let's see what you folks think about this one. What are you expecting for US auto tariffs this year? No auto tariffs, Trump is more bark than bite, or alternatively, maybe to be a little more substantive, to say the constraints and concerns about stability of markets and stability of economic performance are sufficiently persuasive that he doesn't want to go down that road. But no auto tariffs. And then B, tariffs only on the European Union. That is where most of Trump's animus, I think, is focused. Third, tariffs only on the EU and Japan to a lesser extent than the EU. And then auto tariffs on several countries. A more broad effort. And let's go ahead and see where we are here. Wow, you folks are worried about Trump. Okay. That's very interesting. Yeah, and as I said, my baseline is he's going to stay away from it, but it is a distinct possibility. If he does put him on, I can see if he gets the quick win out of China, and the US economy seems to be doing pretty well in the spring, there is a possibility he pivots and says, well, what else can I do in the next 6 months? And it would give him time to impose tariffs, negotiate, extract some rents from Brussels, and get it all off by next spring. This is a very interesting result. Well, in the last couple of minutes of my remarks, whoops, they overshot. Let me just give you my summary and my views as to what all of this means for financial markets. As I've said, clearly the trade war weighed on global markets and risk appetite during the fourth quarter of last year, to a lesser extent, but still meaningful extent earlier in the year as well. My sense is that a resurgence of tensions between the United States and China, or a proliferation to autos, would have very similar effects. You'd see volatility in global equity markets. If it were autos, the euro area equity market would particularly get hammered. And I think it would be a source of softness for the euro. For rates, I think that markets will continue to view a trade war as being a contractionary event, so that the disruption of supply chains and increased uncertainty and so on and so forth would be a factor that would hold back activity, and the markets would not see it as much as an inflationary event, which is also possible given consumer prices are rising. In an environment where this is viewed as contractionary, rates would fall. I think that's broadly what we saw during the fourth quarter of last year. And I would expect the central banks would echo that assessment and reinforce their recent dovish shift. And then finally, in the FX markets, I think this would bring rising risk-off sentiment. It's likely to weigh on EM currencies and create upward pressures on the dollar and the yen. I don't see this as a source, even if we have more tariffs on China, I think that would still be seen as a risk for the euro. And specifically, people would say, well, if he can take this next step with the Chinese, he can certainly at some point over the next year or year and a half do something on Europe. So I think that if anything, further moves on China would make folks even more nervous about the outlook for the euro area. So those are my thoughts. I don't know whether they qualify as upbeat or depressing. Maybe a little more upbeat than the audience. But we'll now take some questions.
Absolutely. Thank you, Nathan. So we have lots of questions in through the app already, so thank you for that. If anyone is desperate to ask a question in the room, do wave your hand now, but we only have 5 minutes, so I'm going to get rattling through. If you think we're worried about Trump, what the list of questions tells me is that our brains are terribly occupied by Brexit, but I'll resist the temptation to jump straight in there. There are quite a few, so let's do something a little bit specific first. There are some further questions on the auto tariffs. And in particular, why not go after Mexico to pay for the wall, amongst other things? But also, how would that work for foreign-owned auto companies that manufacture autos inside the US?
So the idea of going after Mexico is a distinct possibility. My instinct is that he's not going to move in that direction, because he's trying to get the new NAFTA through Congress, and given the nature of what was negotiated, that he'll give Mexico a pass. In addition, the broader the attack on the auto sector, the more risk there would be of market and economic disruptions. And so he would instead prefer kind of a tailored attack on where he sees the biggest problems. And that's in the European Union, and particularly in Germany. Now, in terms of ownership, the way I understand these things working is if you are a foreign producer who's producing automobiles in the United States, if you're bringing over inputs, those would get tariffed. But your final product would include U.S. value added, and it would not be subject to tariffs.
Thank you. So there is a real interest among the questions that have come through about not just what it might take for Trump to be re-elected, so the probability of that, but in particular, does his possibility of re-election really depend on his outcome in terms of trade?
So I would say that the most important factor that will determine Trump's re-election, and right now I would put it as a roughly 50-50 proposition, the most important factor is who he's running against. Who do the Democrats put forward? They put someone who's reasonably moderate, or do they go far to the left? So I think that's the most important factor. Second most important factor is where the U.S. economy is in general. And there I would say the best metric is, where's the unemployment rate? If the unemployment rate is still around 4%, that's going to redound very positively for President Trump. If the economy is still growing, that's going to be helpful for President Trump. In terms of the trade war, I think if he still has tariffs out there, that will be a negative. But I think anyway at this stage that he harvests, there are a lot of things that the Chinese have offered. The Chinese have made better offers to this administration than they made to the previous administration when we were negotiating and in administrations before that. So if he harvests some of that, I think you can plausibly say, I've addressed this in a way that no one has before. So I think he's probably already done enough that as long as there aren't tariffs on at the time of the election, that trade will probably be a positive for him. Now, as I say that, let me also say, the fact that he got concessions out of China, I think is great. That's a distinct positive. But I'm not ready to say that these policies were the right policies. I don't think we'll know until quite some time the full effect that this shift to protectionism in the United States has on the global system, on U.S. leadership, on the way trade is conducted. In the short term, there are benefits, but I'm still worried about long-run implications. I still don't think I could recommend this kind of a strategy to a president or a secretary of the Treasury without feeling a lot of questions and angst about it.
Thank you. Now, I don't think you and I are going to get out of here in one piece if I don't put some of these Brexit questions
Please.
to you before the
Even
clock
though I'm
ticks
always
down.
very humble answering Brexit questions, you folks know a lot more about it than I do.
So there's a definite interest in your view about whether no deal or a bad deal, which is the lesser of two evils. And some people noting that there are some economists who've argued that WTO trade terms are not such a bad outcome for the UK. Can you discuss your view on those points?
Right. So on no deal or WTO terms, I think if we could magically wave a wand and get the US and the UK and the Euro area trading with each other on WTO terms, I think that would be just fine. And I think it probably wouldn't be such a terrible outcome. You know, the U.S. and Britain do a lot of trade at WTO terms. The U.S. and Japan and U.S. and China do a lot of trade on WTO terms. But the problem I have with the no deal and the quote unquote crashing out is what does that transition from where we are today to those WTO terms look like? And it is that uncertainty, the regulatory uncertainty, the legal uncertainty, and a whole list of other kinds of uncertainties. What does that do in the transition? So, like in the long run, I think it would be fine, but how disruptive? And I have to admit, I'm a pretty risk-averse guy, and so I'm not sure what a bad deal would look like, but I think I would be inclined to want to roll the dice on any kind of deal versus crashing out, given I'm really worried what that period of transition, which could be several years, maybe more than several years, might look like.
Thank you. And in the last minute, given the situation that we find ourselves in at the moment, there is a good deal of interest from the audience as to how DB pension schemes should position themselves in the face of the impact of trade war on financial markets. Do you think there is anything they can do to mitigate these risks?
I was thinking about this, and it feels to me like it's a lot of kind of idiosyncratic existential risk that is really hard to hedge. Maybe there are certain ways to protect against sharp movements, because I think that's the biggest risk. The baselines here I think are okay. It's that tail risk that something happens and somehow Britain, it's not what I'd expect, somehow Britain crashes out. Or that my views of Trump that I've described today are too benign, and he just goes to town with more tariffs. And how do we hedge? How do we survive those severe tail scenarios? It's not clear to me.
Well, we definitely picked the right topic in investing on the brink, if that's the case. So this is the last session of the conference for today. We're back at 9:15 tomorrow, focusing on DC investment then. But I'm sure that many of you will want to check out, there is an article that Nathan has written on this topic in the current edition of the PLSA Viewpoint magazine. But lastly, and most importantly, just to thank Nathan for sharing his insights with us today.
Thank you.